Hi, and welcome to One Chapter Closer, the audiobook channel that helps you experience one chapter at a time. Whether you're here to relax, learn, or enjoy great stories, you're in the right place. Let's dive into today's chapter and take one step closer to the end of the book.
The Little Book of Common Sense Investing by John C. Bogle. Introduction: The Power of Common Sense Investing. John C. Bogle, the founder of Vanguard Group and creator of the first index mutual fund, revolutionized the investing world by advocating for simplicity. He argues that individual investors can guarantee their fair share of stock market returns by using low-cost index funds. Unlike active management, index funds track the market, eliminating unnecessary fees and guesswork. Bogle emphasizes the power of compounding returns over time. For example, investing $1 at a 9.5% annual return grows to $37.72 in 40 years. However, excessive costs from management fees, brokerage commissions, and taxes erode these gains, leaving the average investor lagging behind market performance. Bogle believes that embracing simplicity not only maximizes returns, but also reduces stress and confusion for investors navigating complex financial markets. The Parable of the Got Rocks. Bogle's Got Rocks parable illustrates the dangers of excessive intervention in investing. The fictional Got Rocks family owns all stocks in the market, enjoying their proportional share of dividends and growth. However, when brokers convince family members to trade stocks, their wealth growth slows as fees reduce their returns. These helpers create the illusion of added value while quietly siphoning off a portion of the family's wealth. Eventually, the wisest family member advises eliminating these helpers, allowing the family to reclaim their full share of the market's rewards. The parable highlights the destructive impact of unnecessary trading and management fees. By removing intermediaries and embracing a simple, passive investment strategy, the Got Rocks family exemplifies the benefits of index fund investing. This parable underscores a key message: unnecessary trading and fees transform investing from a winner's game into a loser's game. Bogle's critique of the financial industry serves as a wake-up call for investors to question the true value provided by active managers and advisors. The grand illusion of active investing. Many believe that selecting superior stocks or mutual funds guarantees success. However, Bogle debunks this myth with compelling data. Studies consistently show that most active managers fail to beat the market over time. For instance, the S&P 500 index often outperforms the majority of actively managed funds, especially when accounting for costs. Bogle explains the arithmetic of investing. Collectively, investors earn the market's return before costs. Once fees are deducted, the average active investor inevitably underperforms the market. This phenomenon is further illustrated by the zero-sum game concept, where one investor's gain comes at another's expense before costs are factored in. Historical examples highlight this phenomenon, including active fund struggles during economic downturns. For example, during the 2008 financial crisis, index funds demonstrated greater resilience compared to actively managed funds, which often made reactive and costly decisions. The majesty of simplicity. Simplicity, Bogle argues, is the hallmark of successful investing. Index funds, which hold all stocks in a market, offer diversification, minimize individual stock risks, and reduce costs. They also avoid the pitfalls of frequent trading and speculative behaviors, allowing investors to focus on long-term growth rather than short-term gains. For example, the Vanguard 500 Index Fund has consistently outperformed most actively managed funds over decades. By maintaining low costs and broad diversification, it captures nearly all market returns, illustrating the advantages of indexing. Bogle describes this approach as owning the haystack, where investors hold an entire market rather than trying to find the needle of outperformance. The costs of investing. Investment costs significantly impact returns. Consider an 8% annual market return. An investor paying 2% in fees only earns 6%, which reduces their portfolio by almost half over 30 years. High expense ratios, frequent trading, and hidden costs in mutual funds further diminish returns. Bogle highlights that funds with lower costs tend to perform better. Low-cost index funds, which avoid excessive fees, consistently outperform their high-cost counterparts, making them the superior choice for long-term investors. He provides real-world comparisons of mutual funds, illustrating how higher-cost funds fail to deliver on their promises of superior performance. Additionally, Bogle critiques the marketing tactics of financial institutions, which often emphasize short-term gains or recent performance. These strategies distract investors from the long-term benefits of low-cost indexing, leading many to make costly mistakes. The role of taxes. Taxes are another barrier to maximizing returns. Actively managed funds often generate short-term capital gains, taxed at higher rates. In contrast, index funds' low turnover minimizes taxable events, enhancing after-tax returns. For instance, a hypothetical investor comparing an active fund to an index fund over 20 years finds that the index fund's tax efficiency significantly increases their final wealth. This underscores the importance of considering after-tax returns in investment decisions. Bogle notes that even small differences in annual tax efficiency can compound into substantial disparities in wealth over time. The power of patience. Bogle advises investors to adopt a long-term perspective. Market volatility often leads to poor decisions driven by fear or greed. However, the long-term trend of corporate earnings and dividends drives market growth. He illustrates this with a century of data showing the steady rise of the U.S. stock market despite periodic downturns. Investors who stay the course with index funds benefit from the market's resilience and compounding returns. Bogle likens investing to planting a tree. The greatest rewards come to those who allow time for growth and refrain from unnecessary interference. Lessons from history. Historical events provide valuable lessons about the risks of speculation and the benefits of indexing. During the late 1990s tech bubble, many chased overvalued stocks, suffering losses when the bubble burst. In contrast, diversified index fund investors weathered the storm and gained from the market's recovery. Bogle also examines small-cap and mid-cap stocks. While they occasionally outperform, their volatility and higher costs often make them less appealing than broad-based index funds for most investors. He advises caution in chasing hot sectors or trends, emphasizing the unpredictability of market cycles. Another notable example is the recovery following the 2008 financial crisis. Investors who remained committed to their index funds during the downturn were rewarded as the market rebounded, whereas many active investors locked in losses by attempting to time the market. Practical advice for investors. Bogle concludes with actionable recommendations. Diversify broadly. Invest in funds that represent the entire market, such as total stock market index funds. This approach ensures exposure to all sectors and reduces the risk associated with individual stocks or industries. Minimize costs. Choose funds with low expense ratios and avoid unnecessary trading. Over time, cost savings significantly enhance returns. Stay the course. Resist the urge to chase trends or time the market. Focus on long-term goals and maintain discipline, even during periods of market turbulence. Ignore the noise, avoid distractions from market hype and focus on fundamentals. News headlines and short-term fluctuations often lead to impulsive decisions that harm long-term outcomes. Embrace simplicity. Recognize that straightforward strategies, like investing in index funds, often yield better results than complex, high-risk approaches. Simplicity reduces stress and increases the likelihood of success. These principles are endorsed by respected investors like Warren Buffett, who praises index funds for their simplicity and effectiveness. Buffett himself has recommended index funds as the ideal choice for most investors, citing their low costs and reliable performance. Conclusion. The Index Fund Revolution. Bogle calls for a revolution in investing, urging readers to embrace index funds. By aligning with the market's long-term growth, investors can avoid speculation, reduce costs, and achieve their financial goals. He envisions a future where more individuals benefit from the wealth generated by corporate America, free from the inefficiencies of active management. In Bogle's words, the stock market is a giant distraction to the business of investing. By focusing on simplicity, cost efficiency, and patience, investors can harness the power of compounding and secure their fair share of market returns. Bogle concludes with a reminder of the transformative potential of indexing. He believes that widespread adoption of this strategy can democratize investing, enabling individuals from all backgrounds to build wealth and achieve financial security. The revolution he envisions is not just about better returns, but about creating a fairer, more efficient financial system for everyone.
Thank you for listening to this chapter on One Chapter Closer. Congratulations on being one step closer to completing the book. Don't forget to check out our channel for more specially curated audiobooks. If you enjoyed this, please like, share, and subscribe to stay updated on new releases. See you in the next chapter.